Hey everyone, in this week's Trade to Black podcast, we look at news that are making headlines across the world that obviously include the rise in interest rates. So, how concerned are you, and how high will these rates go? And is my house depreciating in value? Well, in this week's podcast, we sit down with a real estate mogul that says these news headlines are getting it all wrong and how your house is still appreciating in value. How? Find out now in our latest podcast. Hey everyone, welcome to the Dales Report podcast. I'm happy to be joined here today, the president and CEO of The Simple Investor, a company that operates in the real estate space, Todd C. Slater. It's been a while, but great to have you back on.
Hey, listen, Chad, I'm so excited about talking to you today, especially on the Dales Report.
Yeah, it's a hot topic to say the least. Real estate, I don't think people realize how polarizing it's been. Especially in the market that you operate in. I know you're across Canada, but started obviously in Toronto, which is arguably the hottest real estate market in North America for the last 20 years. But let's talk about what's been going on recently, especially around the world. Many people worried right now with interest rate increases. Bank of Canada obviously announcing 2 weeks ago that they raised interest rates another 50 basis points. Last week in the US, the Feds announced the biggest rate increase in over 30 years, which was 75 basis points. So if you're speaking to homeowners or real estate investors, what's the big takeaway right now that you can share?
Well, it's interesting, Chad, because I get to ask this question, I think, almost on an hourly basis nowadays.
I'm sure.
Everybody's wondering what the heck is going on with the world of real estate. I'm going to tell you this, and I need everybody to understand. Your value isn't going to change. Yeah, I know we've got interest rates. They are putting some upward pressure on people. But quite frankly, the brick and mortar value doesn't change. I mean, right now, cost of goods, labor, everything else. So when people sit there, that have bought the last few years, interest rates were so low. So it brought some new people into the market. Everybody got excited. We had that crazy runaway market in Toronto, out in Vancouver, those areas. But, if you take a look at the overall market itself, it still has validity. It's still strong. But with the US Fed raising, that 3/4 of a point, I think they're sending a message almost to their own economy. And it's unfortunate because I think they're driving the wrong bus right now. I always tell people, look, open up the pipelines for the gas, oil, get this thing moving, watch inflation, it's going to drop. But right now, we've kind of got this self-imposed increase. And I don't think it's going to be long term. I think what we're going to see is this pressure. And I think eventually, as the stress cracks come into the economy, I think some people are going to push them backwards.
So when you say you don't think it'll take this long, where are we then, like, say, by the end of the calendar year? Do you think this is stuff that kind of like COVID, when the market kind of crashed, but then 6 months later, everything calmed down, everybody started making money because they adapted? Do you see the same thing happening when it comes to this as well?
Well, I do and I don't. In certain aspects, you have to remember what happened during COVID. So, if we go back to March 2020, everybody took a look at the market and everybody got excited saying, oh no, COVID, shut everything down. But what happened was we actually had a pause. And by doing so, the only people that had to sell were normally the lower price. So that's where the rumblings of, the average cost of a home dropped. Well, we're hearing that today, right now in Toronto. We're hearing that in Ontario and Canada and even in the US. What we're hearing right now is people saying, look, at the average cost is dropping. And I caution people from using that analogy, because the people that own the $1 million, $2 million, $3 million homes, guess what? They don't all have to move. A lot of times it's because they want to, not because they have to. So what ends up happening is they pull the houses off the market. They're not jumping in on that spring market. Like this past spring, we didn't nearly see the number of properties that we normally see in an average spring come on the market. In fact, we were running almost with about a 5 to 10 day supply, which tells us right now that just not a lot of people decide to sell. They're like, hey, look, we are where we are. We don't need to sell. We're not going to sell. So then when you have the high end stuff pull back, this skews the average. So this is why we start seeing, and this happened in March 2020, April 2020,
right?
The market got skewed and all of a sudden the numbers didn't match. And everybody says, look, the market's falling. It actually didn't per se. It just meant the lower priced homes were selling.
we published a piece last week showing the steep decline, you want to call it, in the average price of, I guess, the dwelling real estate market in the Greater Toronto area. But when I look further into this, like these were variable rates that were like 1.5% in Canada. Like that's not normal. And when you look at the stats, yes, percentages have been down at an all-time peak from 3-4 months ago, but year over year, you're still seeing an increase in home valuation, are you not?
Yeah, great point, Chad. Because you know what? Here's the thing you got to remember is that you have to use a full year before you actually see a major adjustment in numbers. And here's the one thing everybody's got to be aware of. In February 2022, we had the greatest increase in 1 month basically than we've ever seen. We saw 15 to 20% increases in 1 month. So January to February, some properties actually went up 20%. Now, when we start hearing people saying, well, it's going backwards, it went backwards by 20, 25%, you just lost February's gains, but you didn't lose last year's gains. You didn't lose January's gains. You just lost February, which was completely out of control. Interest rates were so low. We knew that the Fed and the Bank of Canada were kind of hinting at the interest rate increase. So everybody jumped on the bandwagon.
So when I look where you operate in your station out of Toronto, Ontario, for all my viewers in the US, this has been arguably the hottest real estate market in North America for probably 20 years. COVID's still here, but the height of it is not where it once was. People are getting used to traveling again. The restrictions obviously going away. People are going back to work. There's a balance. They're still working from home. So when you look at these large conglomerate areas, especially a city like Toronto that has seen, like, for example, bungalow homes 10, 15 years ago for $400,000 or $500,000 can sell for well over $1 million now. That's how much of an increase. But how do you see this all playing out in markets like this as, people get back to like normal and are working downtown? For example, people that have sold their house and moved out to like smaller communities. Do you think you'll see an influx of buyers coming back in the next year or so that want to move back to the city?
No, you know what? I think what we've seen is we've seen a complete life shift. And I think a lot of people that went into the outer markets, they actually got their dream homes. This was an opportunity for people to realize the value of a home. And I can tell you that's right across North America, probably the world. But if we talk about North America and the markets, because remember, the US and Canadian markets are very, very similar.
Yeah.
So we have our hot areas, we've got our popular cities, then we have our suburbs. And the suburbs, a lot of people, always congregated around the major cities because they didn't like the travel time. But then when you introduced COVID, all of a sudden they were able to realize their dream, a bigger home, more square footage, a pool, a hot tub, a finished basement, those kind of things. This is what everybody realized during COVID. Now, for them to revert backwards, for them to turn around and say, listen, we're going to sell what we got. Now we're going to downsize and go backwards. Probably not. But what we are going to find is that we're going to find more and more people might rent something in the core. They may turn around and just buy a secondary property, that condo that they can use during the week. I've talked to a lot of the major businesses and they're saying, look, we're seeing a lot of our management staff. They're saying, look, we're comfortable in the suburbs. We've got our family situated there. We've been able to get more of a balance of life. So they're willing to turn around and get that secondary property. And we're seeing more and more of that actually in a major Toronto condominium market. We are seeing people that are going to use it for 3-4 days a week and then keep the suburban home.
So the hybrid work model, do you think, is here to stay for sure?
I don't know. I mean, we've got a lot of the major corporations that are saying they want to push their employees back into place. Do I believe in the hybrid work program? I think it is good for certain industries. I don't think necessarily for others. So I think what we'll do is we will see this. This is going to become more of a norm than we thought. Everybody was anticipating everybody flocking back to work, but I think that productivity, technology, I think there's been this huge shift. And I'll tell you, in the real estate world, technology has evolved so much in the last 2 years.
Yeah.
The time where, now, I mean, basically there were people that were buying homes. They'd never been through it. They were basically going through with, either a Zoom meeting with their realtor, walking through, doing everything by DocuSign.
I know.
It's amazing. It's amazing how the industry changed in 2 years.
It's mind-boggling. It's the great resignation era. When you look at high gas prices, you got to adapt to the way people want to work, because let's face it, like you said, technology has been very accommodating for a lot of these people, and they've still maintained production. But I do think that there is some value, obviously, to in person. I think that you'll see a healthy balance. But when I look at even in south of the border in the U.S., are we still seeing large growth opportunities in the state of Florida, Austin, Colorado? I know a ton of people from New York that moved down to Florida, but do you see that trend still moving in that direction as the world does open up? Or do you see people that bought down in Florida eventually wanting to move back up to, like, say, places like New York?
No, actually, you know what? I think I'm glad you pick on Florida, because I think Florida has just been finally coming into their own, as a state. I mean, you really can't beat a state like Florida. It's got everything you could possibly want. They've been open, they've been encouraging people to migrate into the state. They offer so much, and you still have great value. This is the thing. It's the brick and mortar. We always play brick and mortar weighing prices, right? When you take a look at a city like New York, and if you're talking about the core, you talk about Manhattan, our cost per square foot is so high there. In comparison to Florida, the square foot price is so much lower, more bang for your buck. So if people are going to do it, again, we can go back to our hybrid model and say, there are going to be people that will turn around, they'll spend, a couple, either a week per month in New York, fly back, do the hybrid work program in a state like Florida, like you said, Austin, some of the other areas that really, I think, have so much brick and mortar value. I talk about this on my show all the time. We talk about this in real estate investment. Brick and mortar, when you can turn around and you can buy something for less than you can build it for, that
Right.
means you're going to have appreciation in the future.
That's a good point, because the cost of building right now, needless to say, people know is through the roof. Do you see that, as far as, like we said, inflation, building a home? When do we see costs come somewhat down, because people can't keep paying at this pace?
Well, you got to remember that, when we talk about inflation, we got to talk about, is it a commodity? Is it something that we're building? So it's an essential, like, when you talk about a home, right? When you buy that piece of lumber, it's going to be there forever. When we talk about things such as, oil, gas, food, these are the things that you go through on a regular basis. So once you buy that piece of timber, it's there forever. So
Yeah.
this is where escalation, we won't see the same escalation in building material, and where we're seeing the consumable goods. This is what the government is monkeying around with when we talk about inflation. When you take a look at the actual brick and mortar value, the only thing that we're running into, and we're going to run into this because over the next decade, we're going to have a shortage of the trades. So this
Hmm.
is what's going to inflate our costs of construction, which again passes on to the consumer. But it's just because we have a lack of trades. When we take a look at new immigration, both in the United States and in
Yeah.
Canada, we're not encouraging the trades to immigrate. We're not sitting there mandating, saying, look, if you want to come in, you got to be a bricklayer, you got to be an electrician, a plumber. We need more trades because that will control our costs, bring it down, and make it more affordable for people to be able to buy new or renovate.
Good industry to be in, right?
Oh, huge. I mean, if I had a child that was, in high school and looking to, make a career, look, we can take a look at what plumbers and electricians are
I
currently
know.
making. They're at the top, they're at the top level right now in comparison. You can have somebody that's got an MBA, a doctorate, all of these other professions. Well, I can tell you, I know electricians that make as much as a GP.
Is
And so you take a look at it, and they went to, they were apprentices for 4 years, got their license, and there they go. They started a business and doing incredibly well. So this is the thing, but it's not sexy. And this is the one part of it. When we talk about employment, we talk about careers, not everybody wants to do it. And this is why, again, our costs are elevating.
it's sexy if the guy who's a carpenter is driving a Mercedes, though, right?
Yeah,
Right. And you're probably going to
very
see
true.
that. Like seriously, it's like, try getting a 20-year-old that's done university in the off season to basically, like, pick up a hammer and go get a summer job working construction. And all they want to do is obviously run a YouTube channel. There's nothing wrong with that either. But at the end of the day, it's just your point. There is a mass shortage across the world for people in trades work, right?
100%. And this is something we have to be mindful of, especially when we talk about real estate and things that are existing, so, you and I talk, very regularly, just off camera about where the real estate world is going. And one of the things that we have to think about is, if there's something existing, is it better to buy that than try to speculate the future on something else? And this is the thing. The one thing that we're also going to find is we're going to have a shortage for rental properties, because right now with immigration, I mean, you take a look at the number of new immigrants coming into the United States, new immigrants coming into Canada. I mean, when we take a look at that sheer volume, we cannot build fast enough.
I know.
Okay, we cannot keep up with the demand. So where are these people going to live? And everybody knows that if you're talking about new immigration, new immigrants typically don't buy when they land in that country. They have to rent. They have to get associated with a job. They've got to get some credit history. And so when we take a look at that, so what are they going to do? They're going to rent. So the rental market itself, I think, regardless of our interest rate increases, the rental market's actually going to get even stronger during this time.
Demographically, when you look at the country of Canada, what's the stats now of people that say, because we're an aging country, like how much percentage wise are people, let's say, for example, like over 60 years of age? Because we have to fast forward immigration by 300-400% every year for the next 10 years. I was in an Uber car last week in the city, and the driver said, I've been here for 4 years, just saw my family, and I'm basically living in a condo with 4 people. And he wants to move outside of the city and obviously have a home and everything. To your point too, we can't build fast enough. But where are we when it comes to the overall age demographic of not only in Canada, but the US as well?
Right. So you're going to be, in the next 3 years, we're going to be at over 35% of all residents being over the age of 60.
Wow.
Okay? So it's a big, big number. We call it the silver tsunami. And the thing is that, it's not just North America. You got to think about China as well. I mean, we all have this baby boomer generation that everybody's coming over the age of 60, 65. We start talking about 7-year-olds. We have to start thinking about where they're going to shift. Are they going to sell their primary residence? Are they passing it down to the next generation? There's this transferal of wealth. Well, most people's wealth is actually generated from their primary residence, that family home. A lot of people turn around, and especially nowadays, because not everybody has a pension set up. So what happens is, in the end, they turn around, they rely on their home. They're going to sell their home, potentially rent in the future. And these are the kind of things, like there is a huge economic shift that's going to happen over the next decade.
And these last 2 years is just a small glimpse is what we can expect over the next decade or so, to your point. Last thing I wanted to touch on was, where do you see interest rates topping out?
That one, I wish I had a crystal ball, but I'm going to tell you this, Shadd. As far as I can tell, typically Canada follows suit with the Fed, but Bank of Canada actually, sometimes they pull back. They're not quite in step with our southern neighbors there, right?
Yeah.
So even though the Fed went up 3/4 of a point, what we may do is Canada may only go up a 0.5 point. And at that point, I think right now the brakes have to go on, because I think for the overall economy, for people themselves to adjust. The one point I need to make, though, when we talk about these increases, I was on a phone call this morning. I had a gentleman give me a call, and he said, "Hey, Todd, my payments are going to double because my interest rate doubled, or I hear it's going up 30%." So people need to remember, 30% on a 3% mortgage means that it's going to go to 3.9.
Right.
But the problem is, most people take their calculation and they say, "Well, my interest rate doubled." It doesn't mean your payment doubles, and this is the thing, because we're keeping in mind, when you make a mortgage payment, you have a thing called amortization. That's the bigger part. When you're paying down a mortgage, the big part of it is paying down the debt. So your mortgage payment doesn't double. And this is what everybody here. So, I struggle with the media. You and I have always struggled with the media. All they do is they want to create headlines, right? And
headlines, to click ads, to collect data, to make money, to stay relevant, right?
And so you got to stay away from some of the crap that they spew, because quite frankly, looking at the big picture, what we're dealing with, they're just trying to bait people, turning around and saying, 1 in 4 people are going to default. we had a stress test put into Canada, and for our US listeners, it meant that we had to qualify. So if
Right.
we could get a 2% mortgage, we had to qualify at 4.6% to be able to get that mortgage.
Right.
Well, guess what? With the current variable rate, we're nowhere near our stress test over the
No.
last 5 years.
And
So this is the kind of thing that, I think I wish the US had put this into place a few years ago, when we saw the downturn in 08. But quite frankly, Canada did put this in as a knee-jerk reaction a few years ago to an upturned market. And sure enough, you know what? It's going to be saving grace for a lot of people.
I know the banks in Canada, very tough getting mortgages right now. It's a lot different where, let's face it, in 08, you made money off of the higher risk mortgage that you were lending out. So completely false foundation that was put in place 15 years ago in comparison. If you were looking at any market right now, if you weren't tied down to a job, let's say you have a family, you care about, receiving the best return on investment over a 5-year time horizon. Is there any markets that pique your interest, Canada and the US, that come to mind? I see a smirk on your face.
Well, of course, I was going to say, my wife's going to say, can we buy a Caribbean island?
Yeah, exactly.
That'll give her the best return.
Yeah.
Here's the thing. I'm gonna, when I take a look at markets, we did touch on Florida. You talk about Texas, you talk about some of these marketplaces. I'm going to tell you, I'm going to always be a big fan of a suburb, but I call it the suburb of the suburbs. And it's normally, so when you work with suburbs, it's normally about a half an hour to an hour out of any key city.
Okay.
Well, it's the next ring of defense is where I think everybody has to go. It's that hour and a half out. Because no matter what, we have urban sprawl, and we have it on all major centers, no matter what. So I think if you take a look exactly and you can pinpoint it, because a lot of the communities, a lot of municipalities, they're focusing on, more development for healthcare, schooling, they're putting in, more rapid transit to a lot of areas in North America. So what we do is go just that extra half hour.
Yeah.
Okay. Because guess what? Urban sprawl is going to catch up to you. Okay. Because no matter what, with our growing populations in North America, we still need more properties, and it's just going to grow out towards you. You can get ahead of the curve that way.
And it's the balance, right? With the work. If you have to go in once a week or twice a week, you get your balance and you feel like an hour and a half is doable, right? So
it sure is. Yep.
Appreciate the time. Great update. For anybody watching, let's just calm down. The world's not going to implode. I know it's difficult right now with the market conditions, but rising interest rates, it looks like this too shall pass, and we're in all right shape. And real estate is still a very lucrative investment, right?
Yeah, it sure is. Great point, Chad.
Appreciate it, Todd. Let's keep in touch.
All right. Thanks so much.
All right. Take care.
Hey, everyone. Thanks for watching. And if you like this video, wait until you see what we have next. Some of the best thought leaders in the verticals that we cover, from cannabis and psychedelics to cryptos and NFTs and sports wagering. So if you want to learn more, make sure to click on that bell for all notifications. And don't forget to subscribe to our channel. Thanks for watching.